I'd like to welcome my guest, Johnny Fine. Johnny Fine is one of these guys at Goldman that really understands the corporate market. And all I'm going to say, Johnny, is if the Fed builds a policy or a program, usually investors and especially supply will follow. Boy, hot in corporate land. Why don't you tell us what you're seeing?
Well, Rick, we've seen $290 billion of supply in just the last 3 weeks. $290 billion is a pretty good quarter in our market. So to get that done in 3 weeks, especially with almost all the financial ecosystem working from home, is pretty remarkable.
Yeah, it really is remarkable. And Johnny, the Fed really hasn't put one penny into any of these corporate programs yet. And we still are seeing close to $530 billion year-to-date supply. What's driving this?
So I think a couple of things is that, firstly, obviously, the signaling impact of the Fed using investment-grade credit as a policy tool for the first time in its history is immensely powerful. But there's one other part of what happened on March 23rd that I think also was critical, and that is effectively the Fed moving to QE infinity and unlimited purchases of treasuries and mortgage-backed. What that did is that stabilized the treasury market and allowed liquidity to flow back into the treasury market. Prior to that, there had been real concerns about liquidity in US treasuries. And ultimately, if investors are challenging the liquidity of the risk-free instruments in our market, how can we ask them to actually take risk?
You know, Johnny, if you were to tell a viewer that's just a small to mid-sized investor how he should deal with when the Fed says they're aiming for a sector like corporates, we've learned from the ECB that once they made announcements, of course, corporate securities rallied, yields went down, spreads tightened. But the backside of that is that sometimes these programs just end or run out of gas, or the Fed loses the ability to hold up markets. How long should investors give the central bank to hold the sector up as they plow into it?
Well, importantly, I'd like to see the Fed actually start to use these programs. They've used the money market liquidity fund, and that's actually been helpful for stabilizing the front end in commercial paper markets and others. We know the commercial paper funding facility will be online mid-month, but both the primary and the secondary corporate market facilities, as you point out, Rick, have not yet been used. I'd like to see those come online. I think that can ignite the next stage of the rally in the corporate bond market, especially the lower end of our market and the less liquid elements of our market too.